Hi YouTube, welcome to the channel. Today's episode we're going to talk about put credit spreads and how you can use this fantastic tool to get yourself some good returns with limited risk. All right, let's get it. So let's quickly look at refreshing our memories about options and puts. So as we've discussed in previous episodes on this channel, options contract grants the buyer of the contract the right, but not the obligation, to buy or sell the underlying stock that is tied to that contract. And this is done at a predefined price, which is called the strike price, and the contract lasts between the start of the contract date and a predefined expiry date. For this right, the buyer of the contract will pay the seller what is called a premium at the commencement of the contract. And there are two types of contracts. We're only going to look at the put contract in this video. The put contract allows the buyer of the contract the right, but not the obligation, to sell the underlying stock that the contract is tied to at a predefined price on or before the expiry date of this contract. For this right, the buyer of the contract pays the seller a premium. So, what is a put credit spread? You enter into a put credit spread when you anticipate that the price of the underlying stock you're looking at or interested in will be trading above a specific value by the time the contract you enter into will expire. And to set up a put credit spread, you will do two things. First, you will sell a put at a price below the price that you expect the underlying stock to stay above by the time the contract expires, and then you will buy another put at a lower price than the put you sold, but on the same expiry date. If you take fees into consideration, you should expect a net credit for executing these two transactions. And you should expect that you will be risking losing a specific amount, which would be less than what you would have lost if you only sold the put contract. And we will see how this is demonstrated in the example that we will show. If you haven't done so already, please hit that subscribe button and the notification bell so you get to see new videos as soon as they're uploaded to this channel. And if you like what you hear, please share with those on your network that will benefit from this content. And also do us a favor, hit the like button for the YouTube algorithm. You can check us out on Twitter and Instagram. We want to remind you that everything presented here is for entertainment purposes only and not to be construed as financial advice. All right, let's look at an example of a put credit spread. So let's take a look at Microsoft Corporation. If you look at the trend, Microsoft has hit a high and is dropped down the last couple of months. But when you zoom in, you will realize that Microsoft seems to be bouncing off the 220 mark and hopefully is going to be going up again. Given this analysis, if you anticipate that you can go into a transaction and expect Microsoft to close above the $220 mark when your put contract expires, then you can execute a put credit spread that allows you to be able to get some credit from such a transaction with limited exposure. And in the example we will show now, we will see what the difference is in terms of capital required if you sell just a single put compared to the capital required for selling a put credit spread. All right, let's have a look at it. So if we go into Tastyworks, like we said, we're looking to execute a transaction below the 220 mark. So the first option is we could just sell a put. And when you look at selling just a put, you will see the capital required to sell a put is $21,712 for a potential return of $288. So this is what you get for selling a put. However, if you go and do a put credit spread, what you're going to do is, in addition to selling the put for $220, you then buy back the next put under, which is the 217.5. So if I click on the buy, and you see what will happen now. So now you're risking $195 to be able to make $55. And what you see here is it says if the price of Microsoft Corporation winds up being greater than 219.45, your maximum profit is $55. If the price of Microsoft goes below 219.45, then the total amount you will lose is $195. So for the put credit spread, you're getting paid $55 to risk a loss of $195. That is simply how the put credit spread works. Right, this is a breakdown of the comparison of selling a put only on Microsoft versus selling a put credit spread. As we saw in the demo transaction, when you sold a put only, the required capital was $21,715, and the premium that would have been paid was $288. This translates to a return on capital of 1.33%. Whereas for the put credit spread, the required capital was $195, and the premium that would have been paid was $55. And this translates to a return on capital of 28.21%. So you can see the reward is higher on the put credit spread compared to the reward for selling a put only. The difference, however, that must be noted is if the price of Microsoft drops below the 220 mark for selling a put only, you don't necessarily lose this 21,715. What you have to do is buy Microsoft at $220 per share, and you're buying 100 units of Microsoft. And when you back out this $288, that's why your required capital here would be 21,715. And of course, as we've learned in previous episodes on this channel, you can then go on and sell a call, or you can decide to hold Microsoft forever. Whereas with the put credit spread, you will lose $195 if Microsoft's price drops below the $219 that was mentioned in the contract on or before the expiry of the put credit spread contract that you go into. That's the difference, and it's worth noting. So it's higher risk, but also higher returns. By way of recap, the put credit spread allows you to take a position where you can be exposed to a limited risk on the capital deployed in anticipation that the price of the underlying asset will be above a certain value at the end of the contract period for the put credit spread. If the price of the underlying asset goes below that value, you will lose the capital deployed. And when you compare that with the simple put contract, you will be required to put more capital into the simple put contract. But what happens with the put contract is if the price falls below the target strike, you then have to buy the underlying asset at that target price. That's the difference. But if you execute a put credit spread properly, especially as we've seen with the Microsofts, where you have a level of confidence that the price will not fall below your target strike price, then you could come out with some significant returns.